Hello and welcome. You're watching this special interaction we are having last couple of weeks with the market masters, people who've been very experienced in seeing the cycles to help us navigate on how to approach the investing landscape right now. And in that continuation, we have with us somebody who doesn't really talk to media very often. It's a rare appearance on business channels. I'm talking about Mr. Ajit Dayal of Quantum Mutual Fund. Ajit, thank you so much chatting with us today. Nice to see you after such a long time. Let me
Sorry to be here.
understand from you first, how are you overall observing the global landscape? Uh, COVID, we all know, has been an unprecedented pandemic the world is grappling with. What exactly has happened to the world, in your view, apart from growth collapsing and because of which the crude crash? If you talk about the finer details, what are your observations on the global environment right now?
Sure, great. Well, thank you for having me, and it is a joy to speak to. I just don't do it too often. I should do it more often, I guess, to actually come on your channel. But I think we have to go back a bit in history and recognize that, after the Lehman collapse in 2008 September, from that point in time, the entire world has kind of been reflating and printing money and trying to get the economies to move. They've got markets to move for sure. There's been a phenomenal run up in share prices, very good run up in bond prices because interest rates have been coming down. So interest rates and share price of bonds move inversely. So we had this massive asset run up over the last decade or so. And for the last 2, 3 years, everyone's been waiting for something that will slow down the markets and slow down the economy. And they first thought that the collapse would come from something happening in China, a hard landing in terms of economic growth not being there. They thought there'd be something wrong in the Eurozone, that what they call the PIGS countries, Portugal and Greece and Spain would actually erupt. Something would go wrong somewhere. Or even the US, there'd be excessive debt. There would be failure of student loan, of auto loans, which had also picked up recently the last few years. So everyone was expecting something to happen which would slow down world growth and would cause a collapse in stock markets.
Right, Ajit. If we were to take a step back once again, things started to look good. US and China were coming to terms with each other, coming to friendlier terms on the table. There were, small green shoots of recovery being seen in India as well. Surely, on the one hand, some people were still nervous about US market valuations and the way it was perched on after a 10-year rally. But still, growth was looking upwards. Now, with this COVID-19 shock, how far do you think the can has been kicked back? And how also do you analyze the kind of measures with global central banks have taken to cushion the blow on global growth in your view?
Great. So if you look at globalization per se, there's been a lot of discussion and argument, should globalization be rolled back and all? Well, the pandemic is automatically rolling back globalization because there's little movement of people and certainly little movement of goods. But I think there's a fundamental issue that's been raised up because of globalization's past history and past achievements. I think many countries have now realized that relying upon a faraway country, whether it's China or Vietnam or India, for supplies of everything is a bit ridiculous because we've seen the shutdown. I'd like to rewind a bit more in history. In 2002, 2003, we had SARS hit the world. Now, in 2002, 2003, there were no smartphones, there was no WhatsApp, there was no WeChat. So the social media sort of spread about the news of the disease was far lower. But I remember I just got off a train from southern China to Hong Kong in the month of February 2003 when SARS was declared a pandemic by the WHO. And then I rushed from Hong Kong and I went back to Bombay because my father was a doctor when he was alive and I knew he'd look after me, etc. But I remember in May, June of 2003, they were actually considering shutting down the ports on the western side of the US where a lot of goods were coming in from China. Now that was 2003. Between 2003 and 2018, 19, 20, the world has become even more integrated. In addition to the Chinese tourists, the Chinese goods, the goods from Asia, all over the look at it, it's just been a massive increase in globalization. And I think the fact that countries are not making their own masks, their own personal private equipment, sort of their own protection equipment, that's been a huge, huge issue. And I think that's bringing to the fore that should this globalization model change, should there be something that we definitely manufacture in our home countries or not? So I think that's a major shift that many policymakers will address over a while. But to get back to your question about what central banks are doing, so the recovery after 2008-9, after the global financial crisis, was led primarily by central banks printing money, trying to get the economic, sort of the fund settlement system moving, to unfreeze the bond markets, to give money where it was due or not even due when they rescued large firms like Goldman Sachs, et cetera, et cetera. But it was money led. This one has to be government spending led. And Australia and the US to some extent have shown the way. Australia announced within a few days of their planning the lockdown, their prime minister went on TV and he said, I'm going to guarantee everyone's salary to the tune of 80%. And they've taken a 15% to GDP sort of effort to get the economy, to stay alive and certainly not to collapse. In the Indian environment, it's shameful that after 48 days of lockdown or whatever we've been, if you count the curfew and the state bunds that we had, for example, in Maharashtra. So after 46, 48 days, we're still not being able to address the issue. The government has given a pitiful 0.8% of GDP as a boost. Even if you count the fact that they're about to borrow some more money and increase their limits, I mean, that's another 2% or so in terms of delta of total GDP. And that's not enough. You need to have, in my view, between 2 to 4% of GDP stimulus or support just for the poor people. And then you have to talk about companies and small companies and big companies and everyone else. There's got to be an 8, 9, 10, 11, 12% of GDP stimulus. I don't know what these people are doing. I don't know why they're not coming out with a massive program to get things moving, even though we're all sitting in lockdown. There is certain thing that needs to get helped and the government has to help us, and they're not doing it.
Right. In fact, let's take that point forward. But before that, the response to this has to be twofold. One on the medical and health side, and the other on the economic side. And you are sitting out there in Zurich, observing how various, health authorities across the world are addressing this massive pandemic in their own way. How are you analyzing the response, both first on the medical and health side, and then on the economic side, also taking into account that certain measures so far have been taken by Indian authorities as well, while maintaining that their response will be in a phased manner and not outright?
Right. So again, some sort of macro data on this, right? So from 2009, after Lehman, when we start to recover, we have green shoots in the world and the world is moving up in GDP. Between 2009 and 2019, the world has spent collectively, if you look at companies and different corporations effectively, the world has spent more on building Starbucks and on building McDonald's restaurants than they've spent on building hospital beds. Why are we in a lockdown? We're in a lockdown not because this is a dangerous virus. Please understand that. This is not a dangerous virus. I have asthma, so I'm at danger. That's a separate issue. I'm a subset of the population. But for most people, they won't even know that they got the virus. The only reason that we are in lockdown is because there are not enough hospital beds in the world, that if we all get hit, because this virus spreads very rapidly, so chances are we'll all fall ill quite quickly. Though most of us will survive, 99% of us will survive. But the 1% that includes me, people like me who've got asthma, we are high risk. But if we all fall ill, there's not enough hospital beds to get to. And therefore, they said, let's flatten the curve. We want less people coming to the hospital. So when you land up in the hospital, I can treat you well, I can focus on you, and you have a good chance to survive. People like me, the 1% and the very old, etc. But so everyone is suffering because Ajit Dayal has to be saved. That's ridiculous. And the problem is, if we, I did some sort of, I wrote an article on this, that if the world had spent $30 billion, and $30 billion in a $66 trillion global economy is nothing, 0.05%, whatever. If the world had spent $30 billion on hospital beds across all the countries, we would not be in lockdown. And now we have lost a few $1 trillion, anywhere up to $12 trillion in output because we did not spend $30 billion. It's like saying, I have a lot of risk of fire and theft in my house, but I don't buy the insurance. That's what we did. We didn't buy insurance. So please recognize that. Now, given the fact that I was actually in London and I was there on a marketing trip, and I saw that people in London were very, very casual about this. This was March 6th. So March 6th, I'm in London, and people are very casual. I'm nervous, and the rates are rising in London. So I said, this is a failure. I'm going to Switzerland, where I have a son who goes to school here. So I said, come to Zurich. Well, I came to Zurich, and this was as bad. Now, Zurich just sits on the top of northern Italy. In 5 hours, you can take a train from Milan to Zurich. So Milan is the epicenter, and Zurich's got open borders. So suddenly you can have, the entire virus spread to Zurich. So I left Zurich and I said, hey, India's the place to be because the virus there is still very small. And we had just started to screen at the airport, like it was just 2, 3 days before I landed. So I got to India on March 8th night. I quarantined myself for 2 weeks because I knew I had been, to Europe before that. Quarantined myself at home. And just as I emerged on the 22nd of March, we had the curfew. 23rd March was Maharashtra Bandh. 24th March was a lockdown.
Right.
And anyway, so I was actually in India. But to get to the health situation, so even look at the BMC. In the month of March, the BMC announced its annual budget. So now 150 countries have already been infected by COVID. 150. So this not like it's not in a few countries. It's a pandemic. Right. Everyone's been infected. What does the Bombay Municipal Corporation do? And this is shameful. They announce a 2 crore allocation for COVID. Please look at the headlines. 2 crore allocation to COVID. They announce a 500 to 700 crore allocation to building a coastal road. Now look at the mindset of the BMC. Are they out there trying to save the city of Bombay? Or are they out there trying to build a completely irrelevant coastal road, which God knows who's going to be driving when we emerge from COVID? And that coastal road itself is under massive issues because potentially it could flood the city of Bombay. They're building a road that's going to be 6 meters high along the coast, like building a wall. If you have a teacup, if you have a saucer, you pour water, what happens to the water? It stays in the center. So they're building a wall. So the response, particularly in India, which anyway has a very broken healthcare system as the virus spreads and the need to look after people, we have a broken healthcare system. On top of that, in high density cities, Bombay is like a New York, and New York has accounted for 1/3 of all USA deaths. 1/3 of deaths in all of America have come from the Democrat-ruled state of New York. And Bombay could mirror that. Rather than planning for that, our healthcare system is broken. We have bureaucrats who are more worried about the coastal road than they're about trying to look after health. And now they're scrambling. So, it's really been a sad situation in that sense. No planning.
Right. Ajit, sure, fair point. Let's talk about the markets and the investing landscape. What has this pandemic done to valuations in your view, both global valuations and the kind of damage which has happened in India? What kind of observations are there? Your observations on the commentary coming in from various parts of our market, the industrialists talking about the number so far is a clear mirror of that, and industrialists are sounding quite negative. What's been your reading?
So, on a worldwide scale, if you look at the S&P when it fell to its lowest point in March, the S&P was close to where it was at the time when Trump came to power. So it kind of rewind back to 2016 November. That's where the S&P 500, the US stock market was, and then it's recovered from there. Look at our market. So our market was about 18,000 on the BSE 30. I'm an old school guy. So I'll refer to BSE 30 numbers. So it was about 18,000 in September 2013. That's the time when we had the kind of fragile five crisis because Ben Bernanke, the then US Fed governor, said he may raise interest rates. That caused a massive problem across emerging markets, including India. And Indian stock markets fell. The rupee went from 55 rupees to 66 rupees to a dollar within a few weeks. And at that time, we had a planned transition of the RBI governor. We had Mr. Raghuram Rajan, who came in September 2013. And coincidentally, we had Prime Minister Modi was actually nominated as the BJP candidate for the Prime Minister in September 2013. So the markets were at about 18,000 levels then. Prime Minister Modi gets elected in a landslide victory in May 2014, and the markets are at 24,000. So we have a situation where, if you look at the market floor in some sense, it would be the day Prime Minister Modi was elected, and that was 2014. And we've had a massive inflow into domestic mutual funds. The one phenomenal win of the Modi government has been the confidence that people have by moving money back to equity after all the redemptions that happened after the global financial crisis. And the markets tested that level close to on 23rd March. We came down to 25,000 on the BSE 30 index, very close to where we were at the Modi inauguration time, 2014. So in some similar way, right, you had Trump, and then the markets run up and the markets came down nearly to his levels. And then you had Prime Minister Modi use that as a base. The markets ran up and came back down there. But on a PE ratio, the markets are still nowhere close to what they were either at SARS or at the Lehman crisis. The PE ratio of the indices of the NSE 50 or the BSE 30 was 8 to 9 times at the time of SARS, 2003, and again 8 to 9 times PE ratio historical at the time of Lehman. Now we're still at 17. So we were very happy. We were like a 25, 26.
So are you indicating that there's downside scope?
I'm suggesting that people who are talking about this market being a disaster and being a thing have not seen history. History is in terms of valuations, not index levels. So yes, in my view, unless the government steps in, unless the government comes in with a definite and firm plan to rescue the economy, can the market test lows? Of course it can. Will it test lows? Well, if the international markets recover, which they are, and if international investors plan to put more money into India, emerging markets like India, that could act as a floor. So now we have to again look westwards to see if money is going to come in to keep our asset prices alive rather than relying on our own domestic policies and our own domestic retail money strength. That's the sadness. We're still vulnerable to what someone outside the world thinks about us as opposed to what we think ourselves about our own economy.
Ajit, what kind of companies, in your view, would be able to weather the storm? And which are the ones, the fragile business models, which will crumble under the pressure? Market is already writing obituary of the financial sector and are wanting to hide behind pharma, expensive FMCG, and technology. What's the hypothesis on that side, in your view?
So let's look at the pluses, right? So you go into technology because they have high cash, they have no debt. You're going to pharma because healthcare is now going to be a focus of some sort. So that looks like a defensive. You go into FMCG because again they have no debt by and large, and people are still going to consume stuff even though sitting at home. So I may be sitting at home, but I'm still eating food. I'm still trying to shave whenever I can. I may not be having haircuts, but still trying to shave whenever I can. So the FMCG sector is seeing sales. I may not be eating food at a restaurant, but I'm still buying the dal and chawal to cook that food at home. So the sales are still there. The volumes are still there, right? The restaurant guys lost the value add, but the guy who's making me the rice or the dal or the chapati or the ingredients for that, they're still getting their sale of volume. We're not eating less. We're just eating differently. So that's why it's defensive. But let's dwell some more time on the financials. Now, that's been broken, as you know, for a long time. Under the UPA 2 government, we had excessive build out of capex. Some of it, a lot of it could have been crony capitalism. So all the unwinding of that through the NPAs, through the change in the RBIs, all that has come to fore now. And on top of that, you have a real estate sector that has been protected by the government, probably because because a lot of politicians own or have connections to real estate companies in any market everywhere in the world besides India. After the Lehman crisis in 2008, 2009, all the bad real estate companies with unsold apartments, they were cleared out. They were forced to sell their properties or they were taken over by the banks and the market cleared it. In India, what happened is the PSU banks and the private sector banks kept these real estate zombie projects alive. And for the last decade, you have lower sales in real estate, but you've got these companies sitting there borrowing and borrowing and borrowing money, refusing to bring their price down, refusing to give millions of Indians who want property a break in the price because they want their profit margin. So you've had the NBFCs supporting zombie real estate. With the collapse of IL&FS, all of that has come to the fore, and you've had the entire NBFC sector unwinding its position to high credit risk. So whether it's a mutual funds, and believe me, Franklin is not the only fund house that has problems in its portfolio. This is a pandemic across the mutual fund industry. The fund managers on the debt side, on the fixed income side, have made idiotic bets on high credit to show higher rates of returns so they could gather more AUM. And that is now how it's breaking. So I know that people are coming on your channel and they're saying, hey, this is a black swan event. That's a lie. This is a black crow event. There are crows everywhere. And they just took bad credit portfolio risk and it's coming home to roost. The pandemic and the fact that we're all sitting at home is a black swan event. The fact that fund houses have taken excessive risk to show higher returns, to fool investors and capture them into AUM, that is a black crow. It happens every time. That's what the fund industry by and large does. So I'd like to divorce the two by saying that the NBFC system is broken because we have not fixed the Lehman problems. And now the pandemic is the straw that breaks the camel's back. And we're in complete shambles in some sense. And it'll take a lot of prodding from the RBI and the government to get money to flow to the right places yet again.
Well, that's correct. And now, of course, unconditional apologies are also floating about blames on the regulator. But we'll keep that matter for some other time.
Yes.
So, Ajit, if one were to take into all these facts and data into account and build a hypothesis for Indian equities 3 to 5 year far out, sitting here right now, what's the kind of hypothesis you have in a base case scenario, in a worst case scenario, and a best case scenario?
So, firstly, I want to move to the individual, right? The individual is sitting locked down at home, unsure whether they have a job to go to. April is a month when you normally get a salary increment in India. And now you don't know when lockdown is over whether you'll get a job at all and what kind of salary you're going to get. Will it be the same or higher or lower? So firstly, I hope that individuals have kept enough money aside in their savings bank, in their liquid funds, to ensure that for the next 6-9 months, they are safe in case they don't have jobs or whatever. That's the first thing. Moving to markets, our assumption is that for the next few quarters, the economy will be bad. And we don't know how it's going to all evolve. But as you spoke about FMCG and a few other sectors, there is still demand for products. So if valuations are sensible, it's a great time to buy good businesses at sensible prices. They're not inexpensive. For the market to be inexpensive or to go back to the Lehman levels, it needs to hold on to your seatbelts. On an index level, it needs to go back to 18 to 20,000. If the index is at 18, 20,000 on the BSE 30, then on a P ratio, you're back to where you were at the Lehman time. We're at 30,000 plus at this point in time. So that fall may not happen. Don't wait for it. In my view, if you have excess cash and you're in that position where you kept money aside to invest in the market, then please do. If you're fully invested in the market and you're losing money and you have no money in the bank, safe money in the bank, despite the fact that you're losing money, first, please build your buffer. Build your buffer for 6-9 months of expenses because these are very uncertain times and you must have money to look after your family and look after yourself. Forget about the markets in that sense.
Right. All right. On that a bit scary but very honest note, Ajit, I'll let you go. Thanks so much for joining us on the show. and look forward to those very candid thoughts of yours. Not very popular, perhaps on the street, but we welcome honest conversations on our channel. Look forward to have more of you going forward. Thank you so much for your time.
Thank you so much. Thank you very much. Thanks.